Good afternoon and welcome to CW's webinar on our energy update, where we'll be looking at latest developments in terms of price and market movements for coal, petcoke, and natural gas, while also, of course, paying close attention to the renewables market. My name is Raluca Cercel. I'm a CW associate, and it's my pleasure to host today's meeting. Today also serves as an opportunity for us to offer a glimpse to CW's large advisory and research experience with the commodities I just mentioned. So I will kick off with a short presentation of CW Group and then move on to our proven experiences on the energy market, and afterwards to the actual, let's say, main findings of our research on the energy update this year. So as many of you know, we are a boutique advisory group based in the United States with a specific focus on providing market intelligence in the shape of research products or consulting projects to clients from various industries, as you can see them listed on this page. Our scope of work, both in terms of research and advisory, got initiated, let's say, into the energy spectrum due to the specific focus we have on energy-intensive markets. As energy, of course, makes for a large share of production costs for industrial manufacturing, and I know on today's meeting there's a lot of industry stakeholders from the cement and lime industries, to name a few. So, of course, it was only natural for us soon after we started operating to make energy a point of focus to which we dedicate research and advisory resources. But before going into the key examples from our advisory work that, as I said, prove our expertise in the area, I'll run you quickly through our branches of operations. Through our advisory branch, and as I said, more details in the pages to come, we have been very lucky to work with clients from around the world, from various walks of life, be it cement manufacturers, cement equipment manufacturers, the lime industry, the steel industry, graphite manufacturers and end users, as well as fuel suppliers and other stakeholders from investment banking, international funds, and many other. Projects span from sourcing, support, to strategy formulation, and pretty much everything in between. We have successfully helped both large and small corporations realign their businesses in order to successfully meet their goals. Moving on to our research branch, our focus here is to provide analyzed data in the shape of actionable information that is meant to help business professionals, just like yourself, make highly informed business decisions. Relevant to today's topic from our portfolio of research is our Global Green Petcoke Forecast Report, which we have created last year, and we can update it on demand. Very highly reliant on primary research, given that the petcoke market is quite, let's say, not that talkative, hence our research tentacles had to be spread out on the primary side. Also on the petcoke side, our calcined petcoke forecast report. Recently we released a graphite forecast report, which of course covers the synthetic graphite market that uses as a main input material petcoke. And the report we're actually working at the moment, our third update of the oil well cement report, which we will release next week, and we will host a similar meeting to today's at the beginning of next year. Now, just like I said in the case of our Global Green Petcoke report, all of these are informed through primary and secondary research, but most importantly, we think the primary research which we engage in for these projects, which is quite extensive and exhaustive, sets our work apart from other companies that do similar work, simply because we do put in the work and time to make sure that we validate our analysis with people who actually work in these markets. Now, last but not least, our media branch. Perhaps most of you are familiar with our platforms. Meant to keep subscribers up to date with the latest news from the industry, our colleagues from the media department also publish a monthly magazine that's focused more on the cement industry. For the energy side, we actually have two dedicated platforms, the coal and Petcoke, for the coal and Petcoke Global Markets, Coal Week and Petcoke Week. And our analysts diligence research brings to our subscribers on a daily basis not only market information and the latest news, but also data on pricing and volumes and trade. Now, as I mentioned, we have helped clients from various industrial areas through customized projects related to their specific energy needs. And I have listed here just a couple of such projects from the recent past that, say, highlight our different and varied capabilities. Now, strategy-wise, our work was instrumental in aiding an energy-intensive international cement manufacturer reshape their energy portfolio and optimize the supply chain towards efficiency and cost effectiveness. We did so by creating an energy impact model, shaping the governance and organizational design around the sourcing of fuel, reconsidering current sourcing and offering new and better alternatives. By doing so, we succeeded into turning the client into a more nimble energy buyer with, say, newfound reliability when it comes to energy sourcing and their portfolio. We also undertook the task of sourcing coal and petcoke for an Indian cement and power generation group. And we did so by representing the client globally and managing actually the trade execution on behalf of the client. So our task was to find the most reliable and cost efficient sources for the solid fuels and see the trade deal to completion, from placing the order to the cargoes actually arriving to the client's site. One of our largest energy-related advisory undertakings has actually been to advise on the environmental and cost-saving potential of using municipal solid waste as industrial fuel in sub-Saharan Africa and Latin America. We evaluated waste sourcing and quality, analyzed and forecast potential demand coming from various fuel segments, and created a business case for investing in a process facility at a cement company's site. Now, on a more analytical side, we have worked closely with a petcoke buyer in the Middle East to forecast future energy pricing and demand as a means of helping the client shape its long-term fuel portfolio and sourcing strategy in the same time. Now, of course, all of these projects would be very difficult to complete were it not for the fact that we actually track on a daily, if not hourly basis, everything that has to do with the movements of these commodities. And you will see in the coming pages some of the highlights from this constant tracking that we do. And I'm not speaking only about prices and volumes, I'm speaking also about project developments and let's say sort of the supply-demand changes that are happening in today's world and that are going to change the way we look at the future in terms of energy supply, be it that we're speaking about power generation or industrial use. That being said, and thanks for bearing with me through this introduction part, let's move on to our update. And we'll do so by looking at this year's market developments for the coal, petcoke, and natural gas markets. After doing so, we'll look at the volumes. And once we look at the volumes and how supply and demand is looking this year, as well as in the future, we will continue with prices, which I'm sure most of you on today's call are interested in. But to take a look at coal first, the fuel which still makes for the largest source of electricity in the world, coal is seeing something of a chronicle lack of investments in new capacity. Both Deutsche Bank and the Royal Bank of Scotland, and these are just two of the large banks which have stopped lending capital for new mines. Overall, spending on new projects in coal mining has fallen by 80% from $10 billion in 2012 to $2.2 billion in 2018. And that's, of course, an estimation. In the US, for instance, well, coal makes for about a quarter of the energy mix. There are no coal-fired power plants under construction ever since 2015. In China, and we will discuss this in more detail when looking both at prices and at volumes, the government's initiative to curb coal imports, as well as to curb coal consumption at the same time, is having an outstanding impact on global coal prices. The sweet spot for coal miners and traders is actually supplying high-quality thermal coal, which is, of course, growing in demand due to its lower ash and sulfur content. And on this, we can infer that the future trend for the coal industry is less but better. And it will be less indeed. Demand globally is anticipated to see only a cumulated 1% growth to 2040 from 2018, whereas back in 2013, it was forecasted that demand will see a cumulative growth of 39% to 2040. Now, to look at the green petcoke market, this market has probably seen the largest, one of the largest developments this year, namely the banning of imports in India, which is the largest import market for petcoke globally. Though the measure will not lead to import stopping, at least according to stakeholders in India who simply believe that the sheer size of the tonnage that's entering the market now, even in the context of the high prices, as we'll see, makes it impossible for petcoke to not be used as fuel, especially for the cement industry. We are already witnessing, as I said, this year, a shrinking in volumes, which has been happening even before the Supreme Court's decision to ban petcoke, but this happened actually as a consequence of prices increasing too much for the Indian buyers. Nonetheless, as you'll see, pricing is gaining quite a bit of footing due to demand improving in Latin America and in China. Now, in the case of natural gas, the long-term growth of the commodity continues to be supported by solid fundamentals. And I'm speaking here, of course, about the broad-based demand and the continuing expansion of LNG, which is increasing the availability of natural gas globally. A bright spot is the Middle East, where demand is almost entirely met by an increase in the consumption of natural gas. Overall, natural gas's growth in China and India, the two markets which make for half of the future growth in global energy demand in total, will probably propel natural gas volumes to grow faster than coal or fuel oil in this case. Of course, we cannot forget renewables and alternative fuels, which will also see a rapid growth that will surpass even that of natural gas and will continue to be more cost-effective than coal or natural gas, something that we're already seeing for a couple of years now. And the difference between the price of fossil and renewables is increasing even more, making renewables even more attractive. Now, to go into a bit more detail and looking at the actual commodities individually, and first looking at volumes, and we're looking here at coal demand forecast in quadrillion BTUs. This is the EIA's projections. Like I just said, demand for coal is anticipated to grow much slower than anticipated in EIA's latest, than anticipated in EIA's 2013 projection, to the point that, according to the new projection, it will plateau to 2050. There are three main markets that explain this expected future movement. And as you can see on the right side of the page, let's start off with China. As I said, highly relying on coal imports, cheaper than domestic coal, but coal end users in China are being encouraged by the government to use more and more domestic coal to the detriment of imported coal, and of course, in spite of the cost disadvantage that that brings along. Power suppliers in this situation, and most given that they make for most of the coal consumption, it's important to speak about them. They are already looking at new energy solutions and are proving successful in incorporating natural gas and renewables in their energy mix. Across China, coal boilers are actually being replaced with natural gas boilers. More than that, the fact that the governmental directive points towards less coal, more green, also provides a great incentive. Of course, China's declining demand for coal has a oversized global impact at the end of the day, and that is particularly impacting the Australian suppliers, and we will see in a bit how. Now, secondly, coal is also anticipated to decline, though not as sharply in the United States, as coal is becoming more and more expensive to mine, and the cost of renewables, like I mentioned, keeps declining. What is preventing global demand from declining on the future and instead rather plateauing is demand coming from India. Here, growing access to electricity is a governmental priority and will be based on multiple fuel sourcing, coal being, of course, one of them. The manner, of course, in which the government fine-tunes its current coal block bidding process will be essential for the prospective growth, and of course, how end users will secure long-term coal supply. We're already seeing in the case of China, cement manufacturers giving up Petcoke in coal's favor simply because coal is now more affordable than Petcoke. And they're doing so not only by accessing domestic supply, but actually importing it from the United States. And speaking of Petcoke, to move on to sort of what's been happening this last year, and looking at the first 7 months of the year, we can see that total traded Petcoke increased quite modestly in 2018, largely because of the stagnation of US volumes, which is the largest global producer of Petcoke. Not only in the US, but also in Saudi, the year started with a lot of refinery maintenance works, which prevented production from growing. This, however, did have a positive impact on pricing, as we'll see in the next section. Now, if we look to the right side of the page to the importing markets, India's lower imported cargoes in 2018 are not a consequence of the Supreme Court decision, because that happened only later on in the year, but of Petcoke prices from the US increasing to quite a high price point, around $120 per ton for 6.5% sulfur content Petcoke. Cement manufacturers in particular in India have largely, like I said, reverted back to coal and started paying more attention to coal block biddings and to US imports in an effort to secure long-term fuel supply. The market sentiment, however, in India is that the switch to Petcoke can happen if the prices are low enough and recover, let's say, their advantage in front of coal. And this could happen even in the context of the Supreme Court decision to ban imports of Petcoke. China's Petcoke imports, however, doubled in 2018. Part of the reason is that the US and Saudi traders became more inclined this year to ship Petcoke to China at a slightly lower CFR than they would to India, simply because they find the Chinese clients more reliable in the 2018 context, when the Indian government and the Supreme Court have basically floated around countless potential decisions that would affect US import presence on the Indian market. Now, looking at natural gas, here is the market where we're actually seeing more substantial growth. Production actually improved by 2.2% over the last 10 years, driven mostly by gas discovery and exploitation in Asia Pacific and in Africa as well. There's a keen interest in the Middle East, particularly in Saudi Arabia, to exploit natural gas, and there are tons of shale programs that oil exploiters in particular are putting in place to tap on the natural gas growth. In China, here is where demand for natural gas is anticipated to see the largest increase for the coming 5 years. We're looking at a 55% increase, 2023 versus 2018. And this is underpinned by policies which are aimed at reducing local air pollution by switching from coal to gas, and of course, the government's initiatives to limit coal imports. As we will see in the coming pages, natural gas continues to be less expensive than coal, and also more favored due to its environmental impact, which is lesser than that of coal and, of course, to that of petcoke. Now, in terms of power generation, the estimations show that by 2050, about 30% of the world's electricity will be generated by natural gas, while a large part of industrial players, especially those who are currently using fuel oil for energy purposes, will likely switch to natural gas. And this will, of course, happen particularly in the Middle East. Asia will also see a marked change in the coming years in the sense that there will likely be a higher gas use in industrial processes for ignition purposes. That will naturally bring about a change in the patterns of LNG trade, and we anticipate that by 2023, emerging Asian markets will make for half of the global LNG imports. Now, let's see how these supply-demand changes have been impacting and will impact the price of the pricing for the energy commodities we're looking at. And again, we'll start with coal. We're looking here at 3 indicators which have depicted similar movements in 2018. You can see the highlighted area represents the monthly trending of these indicators through 2018. So let's start off with Australian Newcastle. 2018 was a year of rather strong growth, and this was backed by stronger than expected demand coming from one of Australian coal's main clients, which is China. This also explains the hike in prices, which happened specifically in the summer months, and was led by an increased use of air conditioning and electricity in an especially hot summer in China. Now, there's a bit of uncertainty about China's coal import quotas being reset in January. The quotas are meant to limit coal consumption and at the same time give an advantage to domestic Chinese coal miners. And this is part of the reason why we expect prices to decline quite fast in the outer months of the year, namely because as the end of the year approaches, the Chinese authorities are trying to make sure that imported volumes of coal in 2018 do not surpass or are even smaller than that of 2017. Now, the situation, of course, also translated this year and will translate next year as well into Chinese buyers of coal being more cautious about signing long-term contracts and likely placing more emphasis on domestic supply. By 2040, we estimate that demand coming from China for Australian coal will likely drop by a cumulative 57% compared to 2018, while demand coming from Japan from Australia will decline by 71% over the same period. This will likely spell havoc for prices of Australian coal. Japan and China, to give you an idea, make for half of total Australian coal exports. At the moment, the Newcastle port operates at a utilization rate of 76%, and it has been going down this year, specifically in the last few months, quite a lot. Now, looking at the US indicator, we can notice let's say a reasonable hike to more than $60 per ton since the beginning of the year to around $70 per ton in the April to July months. Domestically, in the US, coal is losing ground fast to natural gas, yet coal prices actually increased, like I mentioned, and this happened mostly due to demand coming from India, South Korea, and Europe. Lastly, to look at the Richard Bay indicator for South African coal, Prices hiked quite a bit at the beginning of the year because of coal shortages, which happened as a consequence of very heavy rainfalls at the South African's largest open pit mines. Further supporting the increase in prices were rumors that Eskom, the largest electricity provider in the country, was facing domestic supply shortages. The price for Richard Bay coal has been kept quite steady due to demand coming from India, who's switching up again to coal, and this will likely help stabilize pricing in the future years. And also from Pakistan, a country which is in an industrial mega growth and requires coal both for electricity generation and to fuel its growing industry. Now, to look at Petcoke, we're also looking at an improvement this year for Petcoke. Here we're looking at the FOB price exported from the US, and we're looking at different markets. But this increase to an average of 85, and like I said, to India, the CFR was quite high, especially around March, April, meant that Indian manufacturers, especially cement manufacturers, lost interest in US Petcoke. Like I said, tighter production at the beginning of the year, both in the US and Saudi, correlated with growing demand from China and Japan and Latin America as well, led to this price increase. Now, even though India pretty much, let's say, I'm not going to say stopped, but lowered considerably their imports of petcoke from the US. A lot of US coal is actually heading to India, and cement manufacturers in India are developing a taste for the fuel, some saying that they are considering as a potential permanent replacement for the US petcoke. Coal, like I said, is being traded cheaper than petcoke, and petcoke prices will likely have to fall well below $110 per ton to compete with coal successfully. The Turkish import market is also drying up with cargoes of Russian and European coal replacing petcoke demand, which is also in Turkey considered to be too expensive on a CFR basis. Not only is the petcoke too expensive, but so is the shipping. The Houston Iskenderun route freight increased during this year, and this is a consequence of ship owners asking for higher rates because of lack of backhaul opportunities. Now, lastly, to look at natural gas. In the US, there's a bit of a hike in November, and this happened because the number of heating degree days in early November 2018 went way up compared to 2017 and way over historical norms, and that of course led to more demand for electricity and heating. Prices will likely see a smooth and stable slight growth over the coming years as exploitation will continue, and so will the development of gas-fired projects gaining a lot more footing in comparison to other fossil fuels. Globally, as mentioned, demand has been increasing, and prices saw something of a hike as a consequence in 2018. This mostly happened because China pledged a huge supply boost of 20% more gas supply this winter compared to 2017's winter. China is also planning a huge shale program, so is Saudi, like I mentioned, and coal boilers all over the world are being replaced with natural gas boilers. So that gives us a bit of an idea of how energy portfolios are changing around the world, not only for electricity suppliers, but also for industrial players. Industrial players which have this year been quite affected by the increase in fuel prices, and many of them had difficulties translating this year's revenue into profits simply because of the strain that input costs, specifically fuel, have put on them. Now, to close today's presentation with just a few main ideas, I think are the main takeaways of today's presentation. First of all, US and Saudi petcoke suppliers, perhaps there was a bit of a fear that the Indian market will be closed off, and hence large profits would be lost for US and Saudi petcoke suppliers. Luckily for them, China is emerging as a leading import market, willing to pay more than the Indian buyers were. So definitely a situation of the stars aligning in this situation. Secondly, coal gains price advantage to petcoke, returns to being less expensive than petcoke, but international trade in Asia Pacific to simmer simply because China is taking considerable steps back. And lastly, as the world looks like today, it seems that coal is a fuel of the past more and more, and the natural gas and renewable projects will take the lion's share in terms of power generation and most likely in terms of industrial fuel as well. That being said, thank you so much for being in today's presentation. I hope you have found something interesting. Do email me at the address you see here if you have any questions, suggestions, or if we can help you in any way with your ongoing projects. It will be our pleasure to do so. Thank you so much again, and have a great rest of the day.